Hi, welcome to the third mini-lecture in Chapter 3. In our last mini-lecture, we dealt with the revenue recognition principle. In this mini-lecture, we will be learning the expense recognition principle. We are going to return to page 3 of our Chapter 3 summary notes. The expense recognition principle, sometimes called the matching principle, states that expenses are recognized in the same period as the revenue to which they relate, not necessarily the period in which cash is paid for them. It used to be called the matching principle for that reason. Match the expenses against the revenues that they help to earn. Usually that happens when you incur the cost. Incur means to receive the benefit of the cost. For example, you need a place to locate your company. If you didn't have a place, it couldn't operate. So we match September's rent expense against September's revenue. We need electricity and heat. So we should match September electricity and heat expense against September's revenue. We should not be matching October or August rent or heat or electricity against September's revenue. We want to match the expense you receive the benefit of the cost in against the revenues that it helped to create. In other words, in the same period. Some folks get confused on the difference between an expense and an asset. Remember that an asset provides a future benefit and an expense is a used up or a received benefit. Now let's look at the three situations. First, let's take a look at A. Cash is paid before an expense is incurred. In other words, before you receive the benefit of that cost. The benefit will be received in a future period. Wait, benefit in a future period? That sounds like an asset. And it is. You can't record an expense because you have not received the benefit. So you're going to record an asset. Sometimes we call that a prepaid expense. Now I know that's a bad name because it's an oxymoron. It can't be an expense if you haven't received the benefit. Yet that's what we often call them, prepaids. So prepaids are assets. You're going to receive the benefit of that cost in the future. Some examples of things you pay for now and use later are supplies or insurance that must be paid for ahead of time, like car or homeowner's insurance that you have to pay for a full year in advance. We might call that prepaid insurance. Or perhaps you have to pay rent 3 months in advance, which is a common practice in business. When you pay for it before you receive the benefit of that cost, we call that prepaid rent, an asset. So if you have to pay for something before you receive the benefit of the cost or use it, it's an asset, usually called a prepaid. Since you have to pay for it, we decrease the cash account and we increase the asset account, prepaid whatever, prepaid insurance or prepaid rent. The supplies account doesn't have the word prepaid before it, but it's the same type of thing. Now, once we use up those supplies or the prepaid rent or a month worth of insurance coverage, we will take that amount out of the asset account and record an expense because it's been used up. We will learn how to do that type of entry in Chapter 4. Now let's look at situation B. When cash is paid in the same period as the expense is incurred, that means the period you receive the benefit, the expense account increases and cash decreases. So for example, you have your lawn mowed and you pay for it immediately. You receive the service, so you can record an expense. You paid for it, so you would decrease your cash account. in situation C. You received services on credit and you did not pay for them. Since we received the benefit of the cost, you would record an expense. But you cannot reduce the cash account because you didn't pay for them. You would credit a liability account called accounts payable. Later on, when you pay for what you received, you will reduce both the cash account because you're paying for it, and you would reduce the accounts payable account because you no longer owe the money. Okay, so we now know when to record an expense. We try to match recording the expenses with the period in which they helped us to earn revenue. We record them when we incur them, when we receive the benefit of the cost. But how do we record expenses? Well, in our last mini lecture, we learned that we record expenses by debiting them. Let's take a look at page 4 in our Chapter 3 summary notes. It's based on the accounting equation. We said that stockholders' equity, here's our accounting equation, assets equal liabilities plus stockholders' equity. Stockholders' equity has two parts, common stock and retained earnings. Another word for our earnings is our net income. So retained earnings represents the accumulated net income over the life of your company that you retained or kept in the business. In other words, this is the money that you did not give out as dividends to your stockholders. Now, the way we figure out our earnings or net income is we take our revenues and subtract our expenses. So revenues and expenses are going to be represented as subcategories of the retained earnings account. Since revenues increase our net income or our earnings, they're going to follow the same credit to increase rule, and expenses get subtracted to calculate net income, so we're going to debit them to decrease. There you have it. So now you can watch the next video on how to determine when to record an expense and how to record an expense.